Howdy everybody, welcome back. The ratio analysis train keeps chugging along. I've got 3 more ratios for you in the video right now, all dealing with leverage. And if you've ever thought of leverage before, you may have a picture in your mind of somebody out at a job site working using a crowbar to pull up a board. And that's leverage, but it's not quite the kind of leverage that we're talking about right now. From a financial standpoint, when we talk about leverage, we're talking about the degree to which a company or business uses debt. All right? They borrow money and they hope to make more money off of the money that they borrowed. And that's basically leverage, measuring how much debt or leverage a company is using. And it all sounds good, I borrow money, make more money, but there's a risk involved. No different than the risk that you and I face when we borrow money. First of all, when you borrow money, it has to be repaid at some point with interest. And those are 2 pretty big drawbacks of using debt, because when you borrow money in the present, you don't really know what things are going to look like 5, 10, 15 years down the road, as a lot of people have found out with their student loans. I borrowed money when I was 20 to go to college, and now I'm 40, and things look a lot different. And maybe I've had a little problems paying that back between age 20 and 40, right? And a lot of people in that boat right now. So debt has to be repaid with interest, and if you don't repay it, default, bankruptcy. Bad things can happen. Same for you, same for me, same for any business out there that borrows money. So, you got a risk involved. And a lot of times what happens when businesses get in too deep, they disappear, they go away, they go bankrupt. And about every year, at the beginning of the year, sometimes in the middle of the year, you'll see articles that talk about, here are the businesses that are in deep. Boy, are they in trouble. May not make it to next year. I love reading those articles, not because I want people to fail, just because I love anything that tries to predict what's going to happen in the future. You always go back and see whether or not they were right. So this is Yahoo Finance's predictions, struggling businesses that might not make it to 2024. Since we're talking about leverage, we're talking about debt, I thought this would be a great place to try to find an example. Let's find a business that may not make it. Then go pull up their financial statement, see how bad the debt situation looks, right? So I want to go ahead and click on that article and bring it up here. We can take a look and see if we can find an example. Struggling chains that may not make it to 2024. We're going to ignore the ad for TV shows. We ain't got time for that right now. Sorry, Paramount. First of all, Kohl's. Anybody still shop at Kohl's? The Kohl's Cash and all that stuff. They're on the list right here. Poor sales. People cutting down on extra spending, hitting them hard. No signs of pulling out of the sales slump. Joanne, the craft store, sewing materials, arts and crafts, struggling, borrowing more money. Party City, one that I will not be sad to see go. I'm sorry to say it. I got a significant other, my wife, any kind of holiday that comes up, she's at Party City buying all kinds of stuff. And I'm just saying, I won't be sad to see that one go. But they're already filed for bankruptcy in January 2023. Rite Aid, I don't even know where you can find a Rite Aid anymore. They're behind CVS and Walgreens. But the Gap, down here at the bottom, the Gap and its other brands, Gap owns Banana Republic, Old Navy, and Athleta. They are all struggling. You see, they got net losses in the hundreds of millions. Sales are down. They had a new CEO hoping to cut expenses. So let's go with Gap. If you've been to the Outlet Mall recently in Jeffersonville, Ohio, you know there is no more Gap. It's gone. And so let's go ahead and check out Gap here and pull up their financial statements and try to figure out if their leverage ratios, the ratios dealing with their debt, are looking poor. Here's the balance sheet right here, the liability side. You can see Gap, current liabilities. And you got accounts payable, lease liabilities, income taxes payable, and then long-term liabilities. They got a revolving credit loan. They got long-term debt, long-term lease liabilities. So all told, these are in millions. You're talking close to $9 billion worth of debt there. So 3 different leverage ratios that we're going to be looking at to help us get a handle on, to hope that we can get a handle and help us get a handle on GAAP and what's going on at the GAAP. First of all, the times interest earned ratio. Exactly what it sounds like. How many times over do we earn the amounts that we have to pay for interest on our debt? The second one, debt ratio. And the third one, the debt to equity ratio. All of these ratios together are going to help us evaluate a company's debt position and maybe answer the question, do they have too much debt? Are they in trouble? Let's take that first one right there. Times interest earned measures how many times over a business can pay its interest expense from their recurring income. How many times over can they pay the interest on their debt? Obviously, the more times over they can pay it with the money that they've earned, the better off or safer they are. Calculation. We're going to take income before taxes, and then we're going to add back in interest expense. All right, we're adding it back in because we're seeing how many times we can cover it. Normally, expenses are deducted from income, and so to figure out how many times we cover it, we're going to add it right back in. Then we're going to take that number and divide it by interest expense. So all these numbers that we need to make the calculation are right there on the income statement. We can see in 2022, GAAP had $88 million in interest expense. They had income before taxes of a negative $139 million. Oh, they lost money that year. And so if we think about the formula we're going to use, our calculation, income before taxes plus interest expense divided by interest expense equals times interest earned. We can't even use that year. We got to have net income. In 2022, GAAP did not even cover their interest because they had no earnings. They lost money. When you're losing money, you can't even cover your interest out of your earnings. That's a red flag if I've ever seen one. But if we look at year 2020, the exact same thing going on. They got a loss right there, so we can't calculate times interest earned. We're going to have to use 2021. That's the only year in which they had positive net income of the past 3. So what are we going to do? We're going to take $323 million income before taxes. We're going to add in the amount of interest that they paid, and then we're going to divide it by 167. We get 2.93 times. What that means, the GAAP Incorporated, headquartered in San Francisco, California, they were able to cover the interest on their debt nearly 3 times over out of their income. All right. Seems a little bit low. Think about that for a second. Imagine that you have a student loan and a job. Your student loan, your interest on that is $100 during the year. And your job pays you $300 per year. So you're making $300, but $100 of that is going to interest. That's probably not a good scenario. And that's exactly what the GAAP is looking at right here. So the question is, how do creditors and investors interpret that? If I'm a creditor, am I going to say, yeah, I'll go ahead and extend GAAP some more credit? Or am I going to say, I'm not sure they're having trouble making their interest payments. I'm not going to extend them any more credit. I'm cutting them off. As an investor, you need to look at that number and say, are they at the risk of maybe bankruptcy? Am I going to buy their stock and risk losing all my money if they go bankrupt? So we look at the stock chart. Going back a couple of years for GAAP, it was trading at 18 bucks a share a couple of years ago. And now you can see today, it's half of that, 9 bucks a share. So as far as the investing community has decided, it seems like they have decided it's not worth the risk anymore. Goodbye GAAP. You're too risky. So we got the times interest earned ratio knocked out there. What about the debt ratio? We'll go ahead and tackle that one. The debt ratio measures our percentage of assets that have been financed with debt. Think of everything GAAP owns. What percent of all their assets were financed with debt and not equity? Real simple calculation. Total liabilities divided by total assets. Liabilities divided by assets. Remember, at the balance sheet, that's what we need for making this calculation. You can see we got total assets. We got on the liability side, current liabilities and long-term liabilities. Now, it's kind of a pain. I don't know why this is, but a lot of balance sheets, they won't give you total liabilities. They'll give you the current and then the long-term. And then you've just got to add them together on your own. What a rip-off that is. So we're going to go ahead and do that. We'll have to add up current liabilities and total long-term liabilities to get a total liabilities figure. There we go, 2022, 2021. I've added the liabilities together for you. What you're going to do is you're going to divide total liabilities by total assets to get the debt ratio. So take a moment, get your handy dandy calculator out there, fire it up, do a little bit of math, pause the video, and make that happen. Jot down what you come up with. And let's come back and check your answers in about, I don't know, right now. How'd you do? Did you get the right numbers here? For 2022 at GAAP, their debt ratio is 0.804. In 2021, it was 0.787. Looking at it as a percent, 80.4, 78.7%. What that means, in 2022, 80% of everything the GAAP owns had been financed with debt, borrowed money. In 2021, it was a little bit lower. 78.7% of everything GAAP owned, asset-wise, was financed by debt. Is that good or bad? Well, it depends. How are other companies in the industry being financed? American Eagle, Abercrombie, H&M, all these different clothing retailers. How are they being financed? Are they using similar levels of debt? The other big question, does that level of debt keep GAAP from pursuing opportunities? They almost tapped out. They're at 80%. Okay? Does that keep them from saying, hey, we'd like to buy another company. We'd like to do a new clothing line. We'd like to branch out and do this and that. Well, we can't because we have so much debt, we can't borrow anymore. We're having trouble paying off the debt, paying off the interest, and now we're handcuffed. And now we can't pursue a strategy that we want to pursue because we just have no more room to borrow. From an investor standpoint, does that level of debt put GAAP at risk of default, not being able to pay their debts, going bankrupt? So the debt ratio, 80.4. Seems pretty high. So that's times interest earned, that's the debt ratio, and then finally we have the debt to equity ratio. It's exactly what it sounds like. We're comparing debt to equity, amounts owners have invested. Calculates the amount of debt relative to owner investment or stockholders' equity. Remember, stockholders' equity can come from investors buying the stock of the company originally when it goes on IPO, and also from retained earnings, amounts the company has earned profit-wise and retained in the company. Our calculation there, total liabilities divided by total stockholders' equity. Again, real simple calculation. We need the balance sheet, we need current liabilities and long-term liabilities added together to get total liabilities. If that number is not provided, which it hardly ever is, it makes me so mad. I hate having to do math when I shouldn't have to. Just give me the number. And there's total stockholders' equity right there. Once again, I'll give you the opportunity to do the math on your own. Right after I complained about having to do math, hey, it's an opportunity for you to do math. It's just an opportunity for me to complain. So go ahead and do total liabilities divided by total equity to get that debt to equity ratio. Should get 4.09 and 3.69. So what does that mean when we look at the debt to equity ratio? For every dollar that's been invested into the company, whether it be from a stockholder buying a share of the company on the IPO or retained earnings, for every dollar that has been invested into the company, The company has gone out and borrowed $4.09. So if I invested $1 in GAAP, they've gone out and borrowed $4.09 on the dollar that I invested, with hopefully the idea that they'll be able to use leverage, take my investment, borrow against it, use leverage to earn even more money. See, that ratio has gone up from 2021 to 2020. And so we look, is that good or bad? Well, it depends on who you are. If you're a creditor and you've loaned money to the Gap and they continue to go out and borrow and rack up all kinds of debt and they can hardly cover their interest, on some years they can't cover it because they didn't make a profit, you're probably sweating a little bit. You've got money at stake here. Then you're worried about maybe being paid back. And you don't want them to borrow any more money because they might be tapped out already. So if you're a creditor, that's probably not good. But what if you're a stockholder? Yeah, I'm a stockholder. Take the $1 I invested. Go out and borrow 10 more and make a whole bunch of money off of it. Use that leverage. Just as long as you don't go bankrupt. All right? And so it depends on what party you are. You might look at that debt to equity ratio a little bit differently. But when you take it all together, you take the times interest earned, you take the debt ratio, you take the debt to equity ratio, it seems to spell trouble for GAAP. They're either going to have to turn around sales and start becoming more profitable so they can pay off some of that debt and they can cover their interest. If that doesn't happen, they're going to have to borrow more money, or they're going to have to sell more stock, or maybe start selling off assets. Who knows? And maybe sell off some of the real estate they have in California there and bring in some money that way. And so they're kind of at that ledge. They're looking over the ledge right now and trying to decide what to do before they get shoved over. Hopefully it works out for them. I love my Banana Republic khakis. I'd hate to have to find another brand of khakis. Old Navy, you can go in there and get some good clothes for a few bucks. But dress shirts, button-down dress shirts at Old Navy before for like $3.97. I mean, where are you going to find a deal like that? So I don't want them to go under. Do the right thing, Gap. Turn around sales. Don't borrow any more money. Next time, we're going to be talking about another group of ratios called profitability ratios. You know, the name of the game in business is to make a profit. And so we have a whole group of ratios that analyzes profitability. We can determine how profitable a company is. That's it for our video on leverage. If you have any questions as you're working through your homework problems, or maybe you want to explore a little bit and pull up the financial statements for Kohl's, Party City, and see just how dire their situations look, hey, I would be all for that. You can do the math, do your calculations, and let me know how it works out. I'd love to hear that story. Until next time, take care, everybody.